In mid-April 2026, global equities launched into a highly synchronized rally. The timing presented a clear paradox, as underlying economic indicators remained bleak, and geopolitical tensions were still actively threatening global energy supplies. The S&P 500 broke to a record 7,126. At the exact same moment, the US dollar index surrendered its dominance, beginning a sharp decline. This breakout happened despite U.S. industrial production posting a decline and consumer sentiment resting near record lows, data points that typically signal a fragile or contracting economy. This price action was the mechanical result of geopolitical risk premium compression. It was the sudden forced extraction of a specific layer of fear that had been priced into every asset class. By deconstructing the trading data across this 5-day window, we can map exactly how fear is structurally removed from the global financial system, creating the energy for a new market cycle. To understand the breakout, we must establish the baseline market formula prior to April 13th. Global capital was paralyzed by Middle East tensions threatening to choke off energy exports. In this defensive formula, geopolitical fear restricts the anticipated oil supply, which drives crude prices higher. High oil prices create a secondary wave of inflation. This forces the Federal Reserve to hold interest rates higher for longer to combat rising costs, regardless of the impact on economic growth. The final result of this loop is a defensive flight to the US dollar. Capital moves into the currency for both its safety and its high yield, which structurally suppresses equity valuations. Before mid-April, this feedback loop was the gravitational law dictating global capital flows. Breaking it required a direct hit to the first domino, the oil supply. The catalyst arrived on April 14th. Diplomatic channels remained active, and confirmation hit the wire that the Strait of Hormuz remained clear for commercial traffic. Crude oil prices responded with a sharp pullback from their recent highs, as the immediate threat of a supply shock vanished. Inflation fears instantly deflated, a shift confirmed shortly after by U.S. producer price data that was softer than the market had feared. The bond market responded by pricing out the threat of emergency rate hikes, assuming the Federal Reserve no longer faced an immediate energy-driven inflation spike. Consequently, the US dollar index lost both its safe haven bid and its yield support, dropping through the 98.2 level. The clearing of a single geopolitical bottleneck effectively stripped the dollar index of its risk-driven support, triggering a tactical retreat in its global valuation. This released pressure from the dollar and bond yields allowed the equity market to react. The S&P 500 moved to all-time highs as the macro discount rate pressure that had been holding down valuations was removed. To verify if this was a structural shift rather than a temporary rally, analysts looked to internal breadth, the measure of how many individual stocks were actually participating in the move. While early week gains favored mega-cap tech, Friday rotated into small caps, consumer discretionary, and industrials. From a technical perspective, this broadening participation is the signature of an Elliott Motive Wave 1 structure. It marks a clear transition from defensive cash holding to cyclical growth. The breadth of the Friday rally indicates that institutional capital moved beyond forced short covering to actively allocate toward a new market cycle. The USD-JPY currency pair serves as the ultimate test of whether this global pivot is a permanent structural reversal. USD-JPY fell from the critical 160.00 psychological level toward 157.60 as the dollar weakened and Japan's energy import costs stabilized. However, the pair did not collapse. The structural yield gap between the US and Japan remained wide enough to provide a floor for the exchange rate. Bank of Japan Governor Kazuo Ueda maintained a cautious stance, confirming that the central bank was not rushing into aggressive tightening despite the currency's volatility. This stability in USD-JPY suggests the mid-April event was a tactical repricing of risk rather than a shift in fundamental central bank policy. To find the most sophisticated signal of the week, we have to look at the divergence in the underlying commodities market. During this exact window, crude oil and copper exhibited a stark behavioral divergence, moving in completely opposite directions. The drop in crude signaled the structural removal of the geopolitical and inflation fear that had paralyzed markets for months. Simultaneously, the surge in copper acted as a proxy for returning industrial growth and overarching economic confidence. The alignment of a rising S&P 500, A falling dollar and rising copper provides the mechanical confirmation of an early-stage risk-on environment. True market direction is found by decoding these intermarket divergences beneath the surface, rather than following a single broad index. While risk premium compression can ignite a rally, sustaining that momentum requires a transition to fundamental support. The market now requires resilient corporate earnings, stable retail sales, and healthy manufacturing data to validate these new price levels. Central bank guidance remains a critical variable. Upcoming confirmation hearings for officials like Kevin Warsh will be the next major test for the bond market and yield expectations. The global market has transitioned past the fear of worst-case geopolitical scenarios and is now focused on the durability of the current economic cycle. The mid-April pivot demonstrates how institutional capital rotates based on the compression of risk long before headline economic data ever hits the wire.